Hey everybody, hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Monday, November 4th, 2024. Going into the week, we have consecutive bear bars. We have a bear breakout last week, and you'll notice there's an open gap from the low of 2 weeks ago and the high of the current week. So the low of this bar and the high of this bar. There's an open gap, and that means if a trader bought below this week's low, they were trapped on the bear breakout and they have not had an opportunity to exit at break even on that entry. So right now we have trapped traders. The bears are hoping we continue to sell off, further trapping traders. And when I say trapping traders, I mean you have bulls and bears trapped. Bears trapped out of a winning trade. So if you did not sell here, the market went lower. And if you did buy here, trapped bulls because bulls who bought are now holding a losing position. So the bears hoping it continues to sell off. The bulls hoping for the opposite, for at least a test of this low, so that anyone who bought here, scaled in lower, can avoid a loss on their first entry, make a profit on their second entry. We have been above the moving average for a few bars here, but the problem for the bull case is that we have a spike in channel trend, and we've already come back and tested the bottom of this channel, and this momentum might be too strong for the bulls to buy. In other words, we might need a second reversal. So maybe a reversal here, and then continuation, retest, and then a second reversal. Otherwise, if the momentum continues, we could come all the way down here and test the close of this big bear trend bar, which trapped bears several weeks ago. On the daily chart, we had a bear breakout and follow through, but the follow through bar was an inside trading range bar. It's an implied low one signal bar, and low ones typically pull back. Low ones typically fail to go very far and they pull back deeper. And we get a more complex pullback and a low two. So the odds were there would be buyers below yesterday's low. And when I say yesterday, I'm referring to the prior trading day. So since today is Monday, when I say yesterday, I mean Friday. And typically after you get a trend bar, the market goes sideways for 1 to 3 bars. Remember, every trend bar is a spike, a gap, and a climax. And just look to the left. Lots of two-sided trading here, lots of two-sided trading here. If you watch my earlier videos, you'd remember I was talking about this tight trading range being a possible final flag. We rally, go sideways, and come back and test the midpoint. And we already have. But the problem for the bears here is that we got this bull breakout. And anyone who was short in here and scaled in higher might be looking to exit their shorts at break even. But so far, we will see what the bull reversal attempt looks like. Here's the 5-minute chart for today. So we had a small gap down, and I'm going to back up so we can use and incorporate the context from the prior day. And sometimes I'll use the Globex session, but today we can just use the regular hours session. We have enough information here, and it demonstrates the same thing I would talk about on the Globex session. Going into the day, we had this bear channel, and you can count 3 pushes down, but even 3 pushes aside, we have a channel line. And typically the market fails to break out of channel lines, and bear channels become bull flags, bull channels become bear flags. And in other words, bear channels typically break out to the upside, and they fail to break out to the downside. That's because of the market cycle. And bears are taking profits every time we get near this channel line. And just look to the left. We have a big rally here and a prolonged channel. It's relatively broad. Stop order bulls were able to make money along the way. And there's overlapping swing points, not many open gaps. So not the strongest trend here. More likely that this channel would evolve into a trading range, then get the downside breakout and accelerate into an even stronger bear trend. The bears have to worry about this channel line. They have the low from Thursday. And on the open, they're actually attempting to break out of Friday's low, which is this blue line. And I'll make Thursday's low red. So we're getting a breakout attempt of a couple of different support levels, the prior day's low and the channel line. And most of the time, after that channel line breakout attempt, the market fails to break out and reverses within 5 bars and tests the opposite side of the channel, the trend line. So we tried to break out below, reversed up quickly, and you can see quickly went to the trend line but found resistance. It's easy to see bars 1 and 2 and think that's a pretty strong looking bear breakout. But a couple of problems, we mentioned the context is a problem. 3 pushes down, channel line breakout, low in a trading range. And then you have the tail on the bottom of bar 2. And if this is a strong bear breakout, why would traders be buying into the close of the bar? In strong breakouts, there's a little overlap. Bars close near their lows, and traders don't buy during strong bear breakouts. Everybody's desperate to get short. So that's concerning. That's a little suspicious. And we got the bull breakout 3, follow through 4. Now at this point, still minor, lots of overlap, and almost completely below the moving average. But 3 and 4 is strong enough for a second leg. However, about 80% of the time, breakouts pull back before getting second legs. But what do we notice about the pullback? Bar 2 was a bad stop order signal bar. It's a bear bar, maybe closing just above its midpoint, but following a big bear bar. Not many traders looking to buy above this bar. However, we got a decent rally, and the market went a fair distance above the breakout point, and that creates support here. Traders would sell above bar 2, and those who did got trapped. What are they going to do on a retest? On the pullback, they buy back shorts, and bulls who did not buy also look to buy the breakout point, and that's exactly what they did. So we rallied, trapping traders below, pulled back to the breakout point, relieving trapped traders, and then we rally for 2 more legs. So the rally up to 11, bars 10 and 11 look decent, but it's 3 pushes up, and bar 11 is climactic, one of the biggest bull bars in the entire rally. So because it's 3 pushes, we can see it's a parabolic wedge. The third push breaking out of the channel line. And what did I mention at the beginning of the video? Most of the time, channel line breakouts fail within 5 bars and go back and test the trend line. And that's what we got here. But then we entered breakout mode. The market was in a contracting triangle. There's always different ways to draw it. This is just approximate, but you can see the market is getting squeezed. We're getting lower highs and higher lows. Usually in a contracting triangle, with all this overlap, breakout direction is about 50-50, and there's a 50% chance that the first breakout fails and reverses. It's also really common for the apex of the triangle to get retested after a breakout, and that did not happen today. But in this case, we're going sideways. Then we got bars 22, 23, 24. Think about if you're a bull and you have this bar 21, not a very strong sell signal bar, 3 bar micro channel, not very strong, but it is a micro channel. We're getting higher lows, higher highs. It's a channel on a smaller time frame. It's actually really interesting what happened on bar 21. The exact same thing that happened on the downside breakout here and the upside breakout here. you can draw a channel line from the high of bar 19 to the high of bar 20. And bar 21 broke that channel line and then reversed. And that's much more clear on a smaller time frame. But anyway, we tried to break out of the channel line there, the bear trend line of the triangle, and then any trader who bought below bar 21, because they could argue it's not a very strong stop order sell, they were trapped on bar 22, and 23 did not overlap that breakout point, the low of bar 21. There's a gap, and we fell even further on 24. And that's why 25 was a give-up bar. Traders hoping for the bounce, they weren't getting it. We got a bear breakout with follow-through and more follow-through, and then we had a give-up bar. Now at this point, the bears are probably going to get a second leg. By bar 23, this was probably going to get a second leg. And now we're getting stronger. This could be a measuring gap. The bears are hoping we get a measured move of this smaller trading range and test the bottom of the bigger trading range. Bar 2, you could have argued bar 2 was technically sell the close, consecutive bear bars, one being big, closing near its low. So any trader who sold that close and used a wide stop and did not panic up here, scaled in, they'll probably make money. But there's also probably support at this close and at the low of the day, the current low of the day. So bar 25 probably going at least a little bit lower with support below. We broke straight through the close of 2, but look what happened on 27. We did bounce at the low of bar 2. To me, looks like big up, big down. If we zoom out a little more, you can count 3 pushes down. 1, 2, 3. So as strong as this sell-off looks, it's still a little suspicious because of all the trading range price action. It makes you wonder if it's possibly a second leg trap, maybe a wedge bottom. We continue a little bit lower, bar 30. And just think about bar 30. After this sell-off, is bar 30 a major reversal? No, of course not. Bar 30 is a minor reversal. Profit taking by the bears, but you can see, remember, this red line is the low of Thursday. The market tried to break out of that low, and it's pulling back. It would be stronger if we were getting these kinds of bear bars way down here, but instead we just poked below, and we're starting to pull back. But 30 is a weak buy. There's probably sellers above 30 for at least a small second leg down. 31, low 1 short. It's a strong breakout. Probably going at least a little bit lower, but buyers below 30. Bar 32, strong looking bear breakout bar, but now we have a reversal attempt on 30, and if we get another reversal attempt, that would be a second reversal. And that's what we got on 33. And 33 is what I would call a GTFO bar. Climactic selling, lots of trading range price action back here, far below the moving average. If you're a bear and you're short down here, you got to think about where is your stop. And, in theory, it's way up here above bar 21, but no one's actually going to risk to all the way up here. And think about the logic. If you're putting a stop up here and you're short, if you were to get stopped out, you'd be buying up here. And the reality is there's probably more sellers up here at the top of this sell climax. So probably better to be quick to exit in a situation like this. So when in doubt, you have a bull bar closing above its midpoint and a second reversal with everything I mentioned, trading range price action and unsustainable selling far below the moving average. Probably just get out above 33. And then a give up bar, 35, consecutive bull bars. This is disappointing for the bears. As strong as this sell-off was, this was enough damage to disappoint the traders who sold down here. And so this rally, it'll probably get a second leg up, and the bears will probably get a second leg down. That's big down, big up, big confusion. And that typically leads to sideways trading and will often lead to a triangle. In this case, we continue to rally. The bulls got another bull trend bar, close above the moving average. Some traders will buy until the momentum starts to fade, and right here we're starting to go more sideways. High 1, probably go at least a little bit higher, but sellers above 38, similar to over here. Low 1 short, we went for a scalp, then reversed. High 1, go for a scalp, and then reverse. Starting to go sideways, traders will exit longs, and put yourself in the shoes of a bear down here. Let's get rid of this one. If you sold the close of 32, how are you feeling after this rally? You're probably desperate to get out at break even, and you might scale in by selling below a bear bar, 42. Let's say you did that. If you sold the close of 32, scaled in higher, selling below a second reversal in a bear bar, closing below its midpoint, 42, this would be your average entry price. If the market got here and you were able to avoid a loss in the entire trade, you'd probably be happy to take that, because if you sold down here, it was obviously a terrible trade. The market went far and fast against you. And look what happened on bar 44. It looks like to the tick it tested that midpoint, and traders were happy to get out at break even on the entire trade. But the problem here, big down, big up, big down, big up. The bull's hoping we rally for a second leg, test the midpoint, the apex of this tight trading range, the triangle, maybe even rally higher. But this is enough damage. The bears still need a second leg. That's enough damage. That's about a 50% pullback. A couple of reasons traders were buying there. There's 50%. And 50% pullbacks are common in broad channels and trading ranges. The upside is probably limited. Bulls will likely take profits above bar 41 if we get there. We're going up more, but slowly, not as strong as here. 48, possible double top, second reversal. Traders might get out of longs below it, starting to go more sideways in here. And the market entered a fairly tight range here, 3 pushes up. But the selling pressure, not great. We so far have an open gap between the high of 44, the body, the open of 44 and the close of 48. There's a gap, a body gap there. And that would be shown on the line chart, which plots closes of bars. The market trying to get the upside breakout, but now we have a bull channel. And the odds are we'll get the bear breakout of a bull channel. So even though the bars are above the moving average, the rally is not all that strong. We're also testing near a couple of different resistance areas. We have the open of the day. You can see the market's bouncing off of that price. Not too far above that, we have breakout points. The bar 16 low, the bar 19 low. Probably traders selling up here, the top of the range. I'm beginning to turn down again, 3 or 4 pushes up. The bulls are obviously trying hard to get the upside breakout, but they're failing. When the market tries to do something a couple of times, usually 2 times, and fails, typically tries to do the opposite. Look over here. We rally, parabolic wedge, breakout on a higher time frame. We sell off, high 1. We have a trend resumption attempt above 15, failed. High 2, trend resumption attempt above 19, it failed, and we reversed. Tight trading range in here. Usually, when the market's in a tight trading range, it's best to just wait, do nothing, wait for more clarity, wait for a breakout. Bar 60 is a breakout, but it still needs follow through, and you're in a trading range environment, so you're breaking below 49, and think through the market cycle. 45, spike, pullback, channel. The start of the channel, the bottom of the pullback, typically becomes the bottom of the trading range because channels evolve into trading ranges. Sell vacuum, testing, support, and then traders bought. This looks like it's probably the low of a trading range. 60, 61, probably going at least a little higher, but same problem with over here. We have a contracting triangle with lower highs and higher lows. We got a bear breakout attempt. It's reversing, but now there's probably sellers at the apex of the triangle because 60 trapped traders above, and that creates resistance above. So a breakout, possible breakout pullback. Bulls hoping it's a reversal. We break to the upside, but then 63 disappoints, and the bears may get a second leg down. This blue line is yesterday's low, the low one signal bar. The tight trading range is continuing, going a little lower, but even if we sell off, probably buyers below 61. A little bit of a sell vacuum, 69, and then look what happened. Buyers below. You can also count 3 pushes down, 49, 61, 70, and we might need 10 bars and 2 legs, sideways to up here. Good looking buy signal bar, 70, but nobody bought. The market went sideways. We're also completely below the moving average. That's going to damage the bull case. Tried to get the upside breakout and reversed, and it's probably not worth trading in here, even though we might go a little bit lower. 41 through 44 should get a second leg, at least sideways, and they might be getting it here. Maybe we'll test the 44 close. That's a magnet where traders got trapped. But now we're getting late in the day with about 9 or 10 bars left and very tight trading range price action. I forgot to mention in the beginning of the video that elections can really sway the market. And when I say that, I don't mean the election being tomorrow is the reason we had this big micro channel and then this micro channel reversal. What I'm referring to is the tight trading range price action in here through the end of the day. I think a lot of traders are waiting, and it reminds me of FOMC reports where the market will often be in a quiet trading range going into the report, and as soon as the report is released, there's volatility expansion, and the market suddenly becomes volatile. But this reminds me of that. We're going into election day tomorrow, and look at the range compression. Very tight trading range through here. And you can see the bears got their second leg down, testing the bar 44 close, but that became support. We actually went a little bit lower. The bar 44 low. The 74 tested it, exceeded it by a tick or so. Failed breakout, double bottom, and there's support. I mentioned my trades on Friday, and I definitely didn't go through all of them, but I definitely overtraded, and because of that, I came into today with my confidence a little bit shaken. And when that happens, I'll trade small, and I will try to only take some of the best trades that I see and avoid the minor patterns. What got me in trouble Friday was trying to trade in tight trading ranges. So my objective for today was to not do that. So I saw the trade on bars 3 and 4, bull breakout. I thought about buying the breakout point, decided not to, and I just waited through here. I ended up selling the close of 26 and exiting at the new low of the day. And that was really all I took. I think that was about a 1-to-1 trade. But yeah, that was the only trade I took. And for stop orders today, really tough through here. But it's a tight trading range. It's a limit order market. But, breakout follow through 23. Maybe traders sell below 23, taking a chance. And then I think it becomes sell the close 25. You can sell the close, sell below bars here. After the second reversal, 33. It's an always in flip, which means bears, always in short bears, exit above 33. And if always in bears exit, then always in bulls can buy. So theoretically, there's a buy above 33. Maybe buy the close 35. 35 may have flipped the always in, may have been 36. But buyers here until it becomes more two-sided, and then traders will scalp out and wait for more clarity. And then through here, stop orders were really tough. Maybe you take a chance, 3 pushes up, sell below 53, but you really want a bar like 25 as your entry bar if you're selling here. But instead, they got 54 and they scalped out and went more sideways. Same thing, 58, you take a chance, but disappointing entry bar. And then the same thing, 63, but really hard to hold short in a tight trading range. $78 was reasonable. Double bottom at support, but a little late in the day. Limit order trades. I mentioned this one, probably buyers at this breakout point after the breakout and follow through, 3 and 4. You get filled on 5. And then probably sellers above bar 5. It's a high 1 with a weak signal bar at the moving average with a bear trend line. And just think about if you took that trade. 6 was a disappointing bar, and then you had plenty of time to exit at break even if you took that trade. After 2 pushes up, traders will set limit orders to sell above bar 8, betting that bulls will take profits and bears will sell. Maybe they scale in higher. 11 really is more of a sell to close bar. You can bet that it's a climactic bar, 3 pushes up, and a bigger bar, 11. Micro channel, odds are the first reversal will fail. Sellers above 14, traders would prefer to sell above 14 rather than 15 in a bear micro channel. So we went a little bit above 15, and the entry bar was an outside bar. And that's actually not so bad for the bears because outside bars are trading range bars. They're expanding triangles on a smaller time frame. So if you're selling up here, you're selling high in a trading range on a smaller time frame. And right here, you can tell big up, big down. You want to sell in the upper third. Bad high 2, 19, following a bear bar, 3 bar micro channel, and a tight trading range. Traders all through here will sell above bars and buy below bars. I mentioned the sell above 30. It's a bad stop order buy, very weak minor reversal. Traders will take the sell. But remember, high probability must mean you have bad risk reward. And the edge is really small. So the market goes your way quickly, but then the edge is taken away also very quickly. If you sell here but don't take your profits in just 2 bars, suddenly you've given back a lot of what you've gained. Strong rally, low 1 below 38. 38 might be one of the worst stop order trades on the entire chart. And the point is, when you have a bad stop order trade, everything has an opposite. So bad stop order means good limit order. So buyers below 38 for a second leg up. Same problem over here though. Then you get the high 1, 39. The market goes your way briefly, then pulls back deeper. Limit order buy at the cost average price for the bears. If you sold to close 32, sold more below 42, there's a limit order buy somewhere in there. Some traders will pull up a lower time frame chart and take the stop order trade, maybe on the 1 minute, but you really don't have to do that. And then tight trading range through here. We do have a bull breakout, which should get a second leg, and then 45 through 47 might be strong enough for a second leg. So 47, bad stop order, sell below, which means traders will buy below it. But traders are taking profits above swing points. So now we have 3 pushes up, traders will sell up here. Again, just a tight trading range. So traders are selling high, buying low with limit orders. And that can be said about the rest of the day. Maybe you buy below 61, betting it's the bottom of a trading range. And you can see you bounce there for a scalp. Same with 70. You buy below 70, you get trapped. And think about it. You put a limit order to buy below bar 70, triggered your limit order on bar 73, but then you're trapped and you're disappointed. But trading ranges are forgiving, and this is a trading range. And the odds are if you scale in you'll be able to make money or at least avoid a loss. In this case, you were able to exit at your break-even price. Even if you sold 71, the market would eventually get back up there. But that's what leads to second legs. That's why paying attention to breakouts is the most important thing. It's at the heart of everything that traders do. The bears get a breakout, 73, 74, breakout and follow through. That's probably going to get a second leg down, but most breakouts pull back. So we have a breakout point 70, breakout point 71. You have the 50% pullback level of the bear breakout. And traders are looking to sell pullbacks because this is a trading range. When the market's trending, traders will sell the close, sell shallow pullbacks, but in a trading range, 50% pullbacks are common. And the 50% pullback level here is right near the bar 70 low. So a couple reasons to get short here. And that's the logic that leads to second legs down. 75, vacuum test of resistance, and we sell off for a second leg. It might be kind of hard to see, but leg 1, pullback. Leg 2. Today was a mostly horizontal trading range day with a pretty big swing down, pretty big swing up. But overall, a lot of tight trading range price action in here, a lot here. The majority of the day was spent going sideways. Where do we go tomorrow? Pull up the daily chart again. This bear bar on the daily chart is a weak buy setup. We have a bear breakout, trap traders above, and then a couple of dojis. It's a fairly weak reversal attempt by the bulls. And even though the follow through for the bears isn't all that strong, the odds are there are sellers above this bar scaling in higher, maybe at the moving average. Maybe traders will sell at some distance above this bar, and you can see that takes you to the moving average on the daily chart. And as far as below this bar, probably buyers, you look to the left or at the bottom of this trading range, sell vacuum, but lacking follow through. So all of a sudden the momentum is gone. We're going sideways for 2 days, which leads me to believe we're going to continue to go sideways. But I'll mention one more time that tomorrow is election day, and that will have an impact on the market. However, price action, the price charts give you all the information you need. So it's good to know that there are events going on that can affect the market, but all of your information for basing trades, all the information that you use to base trades on should be on the chart. If you are a price action trader, the chart gives you all the information that you need. All right, thanks everybody for watching. I hope everyone has a good night, and I'll talk to everybody tomorrow.